Ciao everyone, welcome back to the channel. And today we are taking a closer look at Bitcoin, which is rallying more than 3% after dipping below 100,000 US dollar yesterday for the first time since June. So, what does this bounce back tell us about crypto and what risks lie ahead for the broader market? First, let's talk about the backdrop. Bitcoin recently broke below its 200-day moving average, a key technical level. This kind of move often signals stress or change in investor behavior. One of the most important things to understand about Bitcoin is that it's extremely sensitive to market liquidity and to shifts in risk appetite, meaning when investors become more cautious or funding becomes strained, Bitcoin tends to feel the pain first. And right now, we've seen some headwinds building. A government shutdown threat, which impacts Treasury and funding liquidity. A hawkish Federal Reserve stance in recent policy moves, creating more uncertainty about rates. With the shutdown, the Treasury general accounts have been accumulating cash, reducing the flow of liquidity into markets. These factors combined create a sort of cascade effect, putting pressure on crypto markets. Another red flag that deserves attention is funding stress in money markets. For example, the secured overnight financing rate, SOFR, dropped sharply on Halloween compared to the day before. That kind of drop often signals that institutions are pulling back, cleaning up books, or getting cautious. While it hasn't yet spilled over into major market dislocations, so far banks and credit appear coping, it's something worth watching closely. Now, when we think about Bitcoin's recent deleveraging event, yes, it looks a lot like prior episodes. The 2020's COVID shock, 2022's FTX collapse, where excess leverage in crypto gets washed out, ripple effects linger, and confidence takes time to rebuild. In this current cycle, there is still more work to do, even though there aren't major bodies floating to the surface. So far, no large institution defaults. The process of restoring confidence will likely take weeks rather than days. What does this mean for stocks, especially large cap tech and indices like the QQQ, tracking the nasdaq 100? The correlation between stocks and crypto has grown. Market makers often trade both. And when liquidity gets tight, both suffer, okay? Stocks have had a run 6 months up in a row is significant. Historically, looking back to 1928, when markets logged 6 months of gains. The following month tends to be flat or modest gain, not a monster jump. In other words, the strong run so far may give investors pause. Finally, on valuations, there is a lot of focus currently on the AI trade, large tech names, semiconductor firms, platform plays. Are valuations stretched? Possibly in some pockets, but on the other hand, some of these companies are still in high growth mode, making traditional valuation metrics less reliable. What I'm seeing, institutions are starting to look beyond 2026 and positioning now, which suggests a broadening phase might be underway. For example, the market could shift from just the Mag 7 AI names to more under the radar picks that have underperformed for years. In summary, Bitcoin's decent dip and bounce is telling us liquidity and risk sentiment are key drivers. Funding strains deserve attention, even if they aren't yet systemic. The linkage between crypto and equities means we cannot treat these markets in isolation. While large cap tech remains in favor, a broader market move may be brewing. Be prepared for some noise. The leveraging process in crypto isn't done yet. And when that shakes out, the rebound could be meaningful. If you found this breakdown useful, hit the like button, subscribe, and drop a comment below. Do you think the crypto deleveraging is nearly finished, or are we still early in the washout phase? I'll see you in the next one. Thank you for watching. Ciao.